Good morning. Welcome to Bishop Fleming's autumn budget update. For those that don't know me, my name's Andrew Brown and I head up the tax team here at Bishop Fleming. And I'm joined today by four very good presenters, being Len Dean, who is in charge of our VAT team. Len actually has recently joined us. He was previously at PwC where he ran their Scottish office. We also have Pippa Clark, who's a fellow tax partner of mine. In addition to tax, Pippa is in charge of our tech and innovation sector. Mark Richards joined us. He is a senior tax manager in our corporate tax team and is an exceptionally good presenter. So sorry, Mark, for putting you on the spot on that one. And finally, we've got Adele Clapp, who is a director in our personal tax team. So yesterday, the Chancellor actually announced a lot of expenditure, about 150 billion, mainly in education, the health service, infrastructure, cultural, and other things. So we'll see actually how he thinks he might pay for it when we go through our presentation today. He also spent a bit of time talking about hospitality, leisure and retail and how he might help these sectors. He has said that he's going to continue with some business rate relief. So from next April, businesses in that sector will get a 50% business rate reduction, although it is capped at 110,000. So if you're a larger supplier in that sector, you're not going to get a full 50%, but you will get up to 110,000. I'm sure this is quite welcome in that sector. And he also spent quite a lot of time talking about alcohol duty and changes to that. So I'm going to pass here now to Len, who's going to talk about this great news on alcohol.
Yeah, hi, morning everyone. Watching the Chancellor yesterday, did spend quite a lot of time talking about the changes coming on alcohol duty, and whilst they will be very welcome to the sector and me personally, they are a consultation, so we're looking for those changes only to come in 2023. However, they are a significant change to the alcohol duty legislation in the UK following Brexit, and the headlines are, I suppose, that for lower alcohol drinks, the rates will be quite significantly lower. And I'll just pick out a few. In particular, sparkling wine, which currently has a 25% premium rate on top, which will be removed, making certainly English and Welsh sparkling wines, which tend to be a bit lower alcohol, quite significantly cheaper. So certain products in those categories could be up to, say, 65p a litre cheaper than they are currently. Also a reduction targeted for pubs on draft beer, with a further 5% reduction on the rate. So all in all, quite positive changes. But from my point of view, in looking at the budget as a whole, on indirect taxes and VAT, I'm very much scraping the barrel, if you'll excuse the pun, because there was remarkably little on VAT and indirect taxes, a lot of duty rates just frozen. So whilst on the subject of hospitality, I thought I'd take this opportunity to just flag something that I think is very significant in the sector, and that's hopefully relevant for a lot of our audience today. And you'll be well familiar with it. Nothing changed in the budget, but the temporary reduced rate for the hospitality sector for hotels and furnished holiday lets, and also catering and admission to cultural attractions. So obviously there was a 5% rate, which was very beneficial and has been in place for a while. That's now moved to 12.5% VAT rate from the start of this month, and it will stay at 12.5% until March 22. The reason I raise it is obviously there is quite a significant benefit from applying those reduced rates as compared to the normal VAT rate of 20%, which will return in March 22. And I've just been looking at this for quite a lot of clients and looking at how to make the most of those beneficial rates, for example, with taking bookings now or deposits where you receive a payment within the rate band. You apply the rate in force at the time, So, you know, lots of people might consider like bringing forward as many bookings as they can to take them when it's within the 12.5% rate. And that's absolutely something that you should look at, and it's entirely legitimate to do so. And then the other aspect of it that I'm not sure lots of people are aware of is that you do have the opportunity to elect which rate you want to use, where you've got a deposit or early booking payment, and then you've got a subsequent delivery of the service. You can actually, in certain circumstances, elect which VAT rate you want to apply to the consideration. So one thing that I'm interested in looking at is where people have taken payments and bookings before the 5% rate came in, so before July 20, and then delivered the service within the 5% ban period. For example, rolled over holiday bookings and things. There could be an opportunity to revisit the VAT accounted for on the 20% VAT prior to the reduced rate coming in. So I just wanted to flag that. I think it's certainly something worth looking at, and there could be, dependent on circumstances, there could be an opportunity to potentially improve the VAT position. So on that note, I'll hand you back to Andrew, and hopefully I'd love to take questions or follow-ups on those points.
Thank you, Len. I think that's a very good point. If you can take advantage of the lower VAT rate, why not? And I'm sure Len and his team would help anyone they can. And I was very neglectful in my introduction to say, please ask question and answers. There's a question and answer panel. If you put any questions there, we will try to answer them either as we go on or at the end. In fact, there is one question from David Campbell, which I will deal with now. Were there any CGT changes? Now, a lot of people thought they're going to change capital gains tax. There's been talk about it. There was no change to that rate, so you're all safe. We're still at our current 20% or 28% if it's property, so no changes on that. Now, then we're talking about hospitality, and I think they have suffered quite a lot on staff shortages, and as has a lot of other sectors. You know, there's implications with Brexit, and also the COVID isolations and sickness has meant that a lot of firms are suffering with being able to fully staff their business. Now, yesterday he did bring some measures to try and track people back into the workforce, and I'm going to pass over to Adele to perhaps talk us through some of these.
Thanks, Andrew. So, as Andrew just said, hospitality isn't the only sector that's been struggling with staff shortages and retention. So there's more need than ever for employers to review their benefit package and ensure they're competitive in their respective marketplaces. The Chancellor did mention a few incentives to try to encourage lower paid employees to come back to work. And these were mainly the increases in national minimum wage. So in case you missed it, the national living wage is increasing by 6.6% to £9.50 from 1st of April 2022. And for 21 to 22-year-olds, they're getting a 9.8% increase to £9.18. Apprentices are also sort of the big winners because they're getting an 11.9% increase to £4.81. The universal credit taper rate has also been amended so that instead of workers losing 63p of universal credit for every £1 earned, they'll instead lose 55p. So this is going to be a boost for claimants, but there may still be childcare issues to consider, and general attitudes that I've seen have been that this 8p difference isn't going to be that encouraging. One small side point to note as well is work allowances in universal credit will also be increased by £55 a year. Finally, with the government's plans for jobs, there's going to be a lot more support for workers on universal credit and also support for older workers over the age of 50 to try to encourage them back to work. So what does this mean for employers? So potentially there could be more people coming back into the workforce, but costs are going to go up. The obvious one is the increase in national minimum wage, which is going to be a huge cost for businesses to cover at a time when they could still be struggling financially. You also need to bear in mind the cost of making sure you're compliant with national minimum wage. There are substantial penalties for getting it wrong, and HMRC have also brought back naming and shaming in December last year. The other issue is that any arrears of national minimum wage are paid back at the current rates in force. So if you do have any doubts about your processes, you may want to review these now in order to pay any arrears back at the current rates this year rather than the rates from April next year. Just as a quick point for the hospitality sector, tips aren't included when you look at national minimum wage, and going forwards, there's going to be an overhaul of tipping practices to ensure workers actually receive these tips. An additional cost that employers need to bear in mind is the increase in national insurance rates due to the introduction of the social and healthcare levy. Again, this is going to apply from April 22 and will lead to an increase in national insurance rates of 1.25% for both employee and employer. This is on top of corporation tax hike that Mark will talk about in a moment. So it's important to bear in mind that this increase doesn't just apply to amounts paid via payroll, but will also be added to employer national insurance is paid in respect of benefit packages and pay-as-you-earn settlement agreements. For anyone who doesn't know, a pay-as-you-earn settlement agreement is where the employer agrees to pick up the tax and national insurance costs for employees on minor, trivial or irregular benefits. The self-employed are also going to be affected because the class 4 rates are also going to be affected, but voluntary national insurance rates won't be impacted. Also, bear in mind that from April 2023, the additional 1.25% levy will be separated out from national insurance rates, so that employees above state pension age will also be affected. So it's going to be interesting to see if this impacts a return to work for many of those older workers that the government are trying to entice back. It's not all bad news, as existing national insurance reliefs will apply to the levy, so that any employees covered by these existing reliefs won't be impacted. So this impacts employees under 21, apprentices under 25, qualifying Freeport employees, and also we still have the employment allowance. One thing to consider is whether salary sacrifice arrangements may be more tax efficient going forwards. We are still awaiting details of how the new levy, when it's separated out from national insurance, will interact with the salary sacrifice rules. So that's just something to bear in mind. Other small points to note are that national insurance bandings will increase by 3.1% based on the September Consumer Price Index from April 2022. And in addition, the Kickstart scheme, which provides funding towards the creation of new jobs for 16 to 24-year-olds, has been extended so that employers can receive funding until 30th of June 2022, provided a young person starts their job by 31st of December 2021. And applications under the scheme need to be made by 17th of December 2021. The Recovery Loan Scheme has also been extended until 30th of June 2022 for smaller companies, and we have a blog on our website that goes into more detail about this. One final point I just want to make before I pass back to Andrew is with respect to the introduction of the off-payroll working rules. There is yet another House of Lords follow-up inquiry into the implementation of these rules in the private sector. They're currently calling for evidence to be submitted by looking at how much harder these rules have made it to engage workers, the confidence in HMRC's check employment status indicator, and any changes you've had to make to your business in order to incorporate these rules. Evidence needs to be submitted by 15th November 2021. So if you want more information about how to submit some evidence, please contact me. Thank you, and back to Andrew.
Thank you, Adele. I do think the change on the taper and on universal credit is good. Hopefully that might help some people come back to work. Now, the national insurance increases with other tax increases has taken us, I think, to 1950s levels of taxation. So I'm going to pass to Mark, who's going to talk about some of the other increases that have been announced, not only yesterday, but previously.
Thank you, Andrew. Yes, at the same time as the introduction of the health and social care levy Adele has just been talking about, the government also announced an increase to the dividend tax rates by 1.25%. The dividend allowance remains unchanged, but the increased rates are scheduled to apply from the 6th of April 2022. It's in line with the health and social care levy because the government's intention is to incorporate those who would not ordinarily be subject to NIC to make sure they contribute to the health and care fund. From a corporate point of view, companies with outstanding loans to participators incur what is known as a Section 455 tax charge on the value of the loan at the year end. The tax is repaid when the loan is repaid, so it's purely a cash flow timing difference, but the rate is in line with the higher dividend tax rate. As the dividend tax rates increase, Section 455 will also increase, and that could lead to unnecessary additional cash flow issues if tax planning is not done before the company's year end. Another important pre-year-end tax planning consideration should always be the salary versus dividend remuneration strategy. It's been over 5 years since an individual could extract £40,000 a year through dividends without paying any income tax or national insurance at all. At that time, profit extraction tended to lean towards dividends as the preferred method of remuneration compared to salary. But over recent years, HMRC have incrementally reduced their advantage. In fact, in the policy objectives of the 1.25% increase to the dividend tax rates, the government actually states the increase will help to limit the incentive for individuals to set up a company and remunerate themselves via dividends rather than wages to reduce their tax bill. So, are individuals worse off taking dividends compared to salary? It's certainly more likely now than it ever has been, and definitely worth revisiting any remuneration planning done previously. Another of the factors affecting the advantage dividends previously had over salary is the increase to the corporation tax rate, announced in the March budget, but it's coming into effect in April 2023. The increase from 19 to 25% is the first time the rate has increased since 1974, and at the same time, there will be the reintroduction of the small profits rate previously enforced in 2015, along with marginal relief. So from April 2023, companies with annual taxable profits of £50,000 or less will be subject to the small profits corporation tax rate of 19%. Companies with taxable profits in excess of 250,000 will be subject to the main corporation tax rate of 25%. And companies with profits between 50 and 250 grand will pay at 25% less marginal relief, meaning in that band, the effective marginal tax rate is actually 26.5%. The last time a corporation tax return included marginal relief, the thresholds were reduced by being divided by the number of associated companies. From April 2015, when marginal relief no longer applied, the rules changed to a significantly simpler system of looking only at 51% owned group companies. This is especially important when determining whether a company is large or very large for quarterly instalment payments as well. And with the reintroduction of marginal relief, the associated company definition is back. This can have wider and more immediate implications for corporation tax, because if your accounting period ends after April 2023, a potentially higher number of companies are to be included in the calculation. Companies previously outside the requirement to pay under the large or very large quarterly instalment regime could now have to pay their corporation tax earlier than anticipated. And although group taxable profits may be below the 250 grand threshold, depending on how many associated companies exist and which companies generate the taxable profits, it is still possible for the main 25% tax rate to apply. However, one way to reduce taxable profits is through capital allowance reliefs. Broadly, capital allowances let taxpayers write off the cost of certain capital assets, such as plant and machinery, against their taxable income. They take the place of commercial depreciation, which is not an allowable tax deduction. The government made a somewhat surprise announcement in the March budget by introducing the new capital allowance relief, the temporary super deduction. Until March 2023, companies are able to claim 130% of the cost of new qualifying plant and machinery in the year of purchase against their taxable income, and 50% of the cost of new qualifying special rate assets, such as integral features. But what if the asset doesn't qualify for super deductions, either because it might be second-hand or the business is unincorporated? Well, then it's important to consider the annual investment allowance. The annual investment allowance provides 100% relief for certain capital purchases up to £1 million a year. The definition of qualifying capital expenditure is more widely drawn compared to super deductions, which means it's applicable to a higher proportion of business assets. Up until yesterday lunchtime, businesses were working on the basis that the £1 million annual limit was going to reduce to £200,000 on the 1st of January 2022, with transitional rules that could drastically reduce the relief available depending on when an asset was bought. The Chancellor has fortunately delayed that headache by extending the £1 million annual limit until the 31st of March 2023 to tie it into the increased corporate tax rate and the ceasing of the super deduction. Back to you, Andrew.
Thank you, Mark. I think rates is really interesting in the UK because there's about 25 personal different rates when you work it out. And I think with that interaction with the change in dividend rate and CT rate, it's more important than ever to look at what your own position is. And there are lots of ways you can sort of get the income in the right band. So it's well worth looking at that planning. Now, the Chancellor also yesterday talked a lot about increases in productivity and also research and development. Now, Pippa, as I said, already heads up our tech and innovation team, is going to have a talk about these.
Thank you, Andrew, and good morning, everyone. So with tech and innovation being a core part of the government's plan for growth, it was really no surprise to see some announcements yesterday about this. I mean, the good news is there is continuing focus on investment in tech and innovation, but there is definitely some scaling back. We had already seen, and we know that there is to come, some more investigation and a bit more rigour around things like R&D tax credit claims. We have got a commitment to public R&D investment. There's still £22 billion committed, but that's now going to be spread over a longer period. And there were some key announcements yesterday on a couple of areas of fairly significant reform to the R&D tax credit regime. So R&D tax credit regime is designed to encourage innovative companies in terms of their spending on qualifying R&D projects. So where there is a qualifying R&D project, that's where there's something being done which is seeking an advance in science or technology. And where a UK-based company has activities that qualify as R&D activities, they can make a claim to have some cash benefit through the R&D tax credit regime. And that tax benefit can be in the form of cash of around 33% if you're an SME. And if a business is not an SME, or if it's an SME that doesn't qualify in full for the SME regime, which can happen, then you can get back at about 10% of everything that you spend on qualifying R&D. And I'm using the word qualifying quite a lot because, first of all, you have to define whether there is actually a project that qualifies under the definition. And then when you have decided that that's the case, you also have to look at what is the spend on the project and which categories of spend are included in the amounts for which an R&D tax credit claim can be made. And the first change that was announced yesterday was a change to the categories of spend that qualify for the R&D tax credit incentive. So that's where there's some good news. That list of qualifying spend areas is being expanded. So we're going to see added to that list spend on data and cloud computing. So for any businesses where there's quite a lot of spend on data and cloud computing that relates to their qualifying R&D projects, this will certainly be good news. And that's due to be introduced from April 23. We haven't got the full details. There's going to be some consultation, but that is good news for where that's a core part of the spend. But the second change that we saw announced yesterday, the second area of reform, that's something that's likely to limit what is qualifying for the R&D tax credit incentive. And here we've got a territorial aspect being introduced into the claims. So we already have a territorial aspect purely in the fact that R&D tax credit claims can only be made by businesses that are in the UK corporation tax regime. But this is a further restriction on what a claim can be made for. So currently, if you have a qualifying project, a business can claim for the spend on the R&D activity wherever in the world that activity might be taking place. So we see this a lot with the work that we do to help businesses access the R&D tax credit claims. So you might find, and this is quite common, that a core part of the project relates to some sort of software development, for instance. And it's not uncommon for that to be subcontracted to a third-party provider, and for that third-party provider of the development team, the people who are actually going to do the software development, to be based overseas. Now, at the moment, that can be included in your R&D tax credit claim. We haven't got the details, but it seems highly likely that that's going to be excluded going forward from April 23. Another area where we commonly see this is in the life sciences area. So where there's something that's being developed to have a public health benefit, that has to go through rigorous testing. You commonly have clinical trials that are conducted on a worldwide stage, At the moment, those clinical trials will qualify for a UK-based company, no matter where in the world the clinical trials take place. But that is going to change, and we think that that will probably mean that it's only for the UK-based clinical trials that they'll be able to be included. So this is a significant change. We don't know all the details, and it is to be hoped that there will be some carve-outs from this restriction. However, we do get a sense of what there is intended by this restriction purely in the numbers that were talked about yesterday. So there was reference yesterday to nearly £46 billion worth of spend on R&D activity for which a UK R&D tax credit claim is made. And in the numbers that were referenced, there was then reference to only about 25 billion of that is estimated to relate to activity that actually takes place within the UK. So you can see that we're talking about potentially a reduction of nearly half in what will be considered qualifying activity spend to be included in an R&D tax credit claim. So that clearly is very significant in this valuable tax relief that many businesses have grown accustomed to claiming and relying on and bringing into their cash flow plans for their reinvestment in the development of whatever it is that they're doing. And that might be some sort of new product development, it could be product enhancement, it could be process improvement. We do see that there's qualifying R&D activity undertaken across all aspects of a business. So the corollary of that really is to try and encourage the UK-based activity. We have seen announcements about the visas for highly skilled workers that are going to be introduced from April 22. So that should help encourage talent to come into the UK and make it easier to bring that talent in. We're also seeing that the government is introducing a global talent network, and that will be designed where the government goes out to specific regions in the world in order to encourage particularly talented, highly skilled people to base themselves in the UK. So the government itself is going out to seek that talent and bring it to the UK. But really, for any business that's got innovation at its heart, where it's looking at enhancing products, procedures, or processes, you should really think about to what extent can you currently claim your R&D tax credit, take advantage of what the regime is now. You need to consider if you're going to be affected by these changes. You need to model the cash flow impact. And you may want to think about reviewing your operating model. That might sound quite drastic, but you've got a bit of time to bring that in, and you have got the advantage of the new visa entitlements. So I think that's everything that I wanted to say on that area. I'll pass you back to Andrew.
Thank you, Pippa. I think I would just say the R&D tax relief is really good, and we've got lots of clients that get lots of money back on that. So if you think you might qualify, feel free to have a conversation with Pippa or the R&D team and see if they can help you. Whilst talking about tech, there has, particularly in COVID, I think, an acceleration on the move to online sales. Now, there is an argument that online retailers have quite an advantage, particularly over business rates. So they tend to be in warehouses which pay low business rates compared to the high street. Now, the government have announced they are going to run a consultation in the next couple of months on having an online sales tax. This would apply on the sales online in the UK and be used to subsidise a reduction in business rates for the high street. So we'll have to see where that one goes. There's quite a lot of arguments to and for and against that one. But whilst talking about online sales, this is quite a complicated area, and particularly on VAT actually. So I'll pass to Len, who perhaps can explain a bit more on this position.
Hi, yes. Online sales always something to keep an eye out for from a VAT point of view. Particularly, I would say, over the last few years, a lot of businesses have switched to more and more website sales, and as you know, you have to be pretty careful about where those sales are going, because that can trigger other VAT registration requirements and VAT liabilities in other countries. So I thought it'd be just a good opportunity to refresh on that. There's been a lot of change this year obviously because of Brexit kicking in on the 1st of January, and the UK leaving the EU. So with traditional, standard B2C online sales, we were no longer part of the distance selling regime, which we've been in since we were in the EU. And the EU has now launched its new replacement systems for distance selling, where there's a single €10,000 threshold, so that for the whole of the EU. So that's very quick to trigger when you're selling stuff off a website, say, to consumers in the EU. And there's some schemes that the EU have introduced to facilitate complying with that. I'm not going to go into lots of detail about all of them. The one that's probably the most relevant for us in the UK is if you're supplying into the European market and your imported goods, say from the UK or somewhere outside the EU, going into consumers in the EU. There's a scheme called IOSS, which is to allow you to register somewhere in the EU to account for the relevant import VAT in whichever EU country it is, with a view to making the delivery much slicker to your consumer customers. But there's issues around, you need a fiscal representative, and that fiscal representative in the EU is jointly and severally liable, which actually is a big headache and has resulted in not many fiscal representatives wanting to take that on. They're being quite hard to find, and also they're charging very high rates. So just something to be aware of, where if you're lining up to or starting out on web sales going into the EU, questions then arise about, is it better to have an entity there, make use of the EU's internal distance selling scheme, the OSS, which may be a bit simpler to operate. And then the flip side is stuff coming into the UK. We have had a bit of a kind of easing into it this year, with the UK government allowing imports from the EU, allowing for the import declarations to be delayed. So that actually caused loads of confusion at the start of the year. Lots of my clients were going, we don't know where our import VAT is, what's going on, have we made any declarations? Stuff's just continued coming in. I think people are starting to get their heads around it now, catching up, making those declarations for goods coming in from the EU. And there's obviously the postponed import VAT accounting, which goes along with that, which in most cases is a very beneficial cash flow benefit, because you just account for your import VAT on the VAT return and reclaim it back at the same time. So there's no outlay, no waiting for a C79. So that's a positive thing. Just to flag that point, make sure you've got your delayed declarations in, because you've only got 6 months to do it, and then there's bad things happen if you don't. That system is also coming to an end on the 1st of January 22, at which point we'll be back to declarations needing to be done at the point of arrival for EU and non-EU. So that will balance off at that point in time. But I think it's something that I've been talking to my clients an awful lot. So I just thought timely to flag it right now. And yeah, happy to take questions. I think that I've seen there's one on iOS application being a nightmare. Amen to that. And I think the question is there anyone doing it for a sensible price? It depends what you define as sensible, because I think it isn't cheap, and I think it's because of the risk that's on the fiscal representative. But I think a colleague of mine did managed to get a contact who was doing it, but I don't think it was what you might call a sensible price. But that might be something we can pick up separately afterwards. And I'll hand back to Andrew. So.
Thanks, Len. Yes, it's incredibly complicated, I think, that whole area at the moment. Hopefully it will settle down over time. Now, as I said earlier, there wasn't a change to the CGT tax rates. There was some change, though, to CGT, and I will pass to Adele to explain what that was.
Thanks, Andrew. Sorry for the delay there. So yeah, as Andrew mentioned, there weren't very many changes in personal tax. The main change to capital gains tax was an extension to the time frame of when CGT returns for the disposal of residential property need to be submitted and the CGT paid. So this has increased from 30 days to 60 days for any properties that complete after 27th of October. So as someone who has been helping clients with these forms, this change is actually very much appreciated. Again, no mention of the introduction of a wealth tax, and the only changes to pension tax other than the increase is literally an increase in the age that a person can access their pension funds. So from 6th of April 2028, the age has gone up from 55 to 57. There's also been a small change so that anyone who realises they've had a historic annual allowance pension tax charge, and this is where they make pension contributions that exceed the annual allowance, bearing in mind this is normally 40,000 but can be tapered for high earners. They can now request that the scheme pays this charge on their behalf, provided the amount payable in the historic years is £2,000 or more. The request can be made for tax years from April 2016, but only comes into operation from April 2022. Again, income tax bandings, personal allowances have all been frozen until 2025. So in effect, a lot of individuals are actually going to see a decrease in their income from April when this hits. Interestingly, although the government mentioned the complications with alcohol duty and how this system's out of date, they haven't mentioned anything about how complicated the income tax system is. So if you consider the complexity of the current system, not only do we have 3 different tax rates for non-savings and savings income, we also have dividend tax rates. We're going to get the levy. We've got the devolved tax rates dependent on where someone is living, high income child benefit clawback where someone's income's between 50 to 60,000, the taper of universal credit, the tapering and eventual loss of the personal allowance where income is above 100,000. On top of this, we have pension annual allowance charges, 5 different CGT rates dependent on reliefs, availability of the basic rate band and a type of asset being sold. So added to this is the complexity with the different rates and bandings for national insurance, and this is before we even think about the definition of employment status, which HMRC has still not clarified. But HMRC very helpfully did say that they have now clarified their current rules with respect to discovery assessments, so that if you do get anything wrong or have historically got anything wrong, they can now raise assessments where a taxpayer is affected by child benefit clawback, potential gift aid charges, or annual allowance pension charges. So this clarification of the current rules is retrospective. So if you are aware of any mistakes you have been made, it may be worth rectifying this sooner rather than later. Other than that, nothing really new on the personal tax side. So back to Andrew.
Thank you, Adele. As you can see, the tax rates on particularly in personal are so complicated, but there are things you can do. You know, if particularly if you're married, being able to share income between spouses can seriously reduce that tax rate. So it's always worth looking at that and planning your best position. Now, before we move on to questions, there is a final change I was going to talk about, which is it affects sole traders and partnerships. And this is a change in the basis, the way the basis period works for that. What I mean by that is at the moment, if you're, say, a partnership and you've got, let's say, a 31st December year end, then in the tax year to 5th April 22, you would be taxed on the profits of your accounting year ended 31st December 2001. So it looks back and say which accounting period ends in that last tax year, and that's the profits which you get taxed on. Now, the government's decided this is far too complicated, and so they're going to move it to an actual basis. What that means is that you will have to get taxed on your profit that rises between 5th of April and 6th of April and 5th of April each year. Now, if I take my 31st December year end, what that would mean is that each tax year, I'm going to take 9/12 of my profit to December, say, 21, and then 3/12 of my profit to December 22. Now, these rules have been delayed a year, but they're going to come in 24-25. Now, I don't think this is a simplification, because if you think about it, when you get to 24-25, you've done your December 24 results. You have to do your December 25 results before you know what your tax is to the 5th of April 2025. So bearing in mind you have to pay your tax on the 31st of January following in 26, you've got a month to work out what that profit is. I don't think that's simplification. Now, there is quite a nasty in the transition year where you're going to get more than 1 year's profit taxed if you haven't got a 5th April or 31st March year end. So my December position, when we get to 5th April 25, they will be taxed on the 12 months to 31st December 24 plus the 3 months to 25. So they're going to tax on 15 months. They will get some relief for something called overlap relief, but if you've been around a long time, it's not going to help much. That extra tax you'll be able to spread over 5 years. So look, I think if you're a partnership, an LLP or sole trader, you need to look at these rules before they come in, because there will be a big sting in the tail when you get to that year. Now, I think what we're going to do now is have a look at some of the questions that have been raised, and I will start with, I think, Adele, you've already covered the CGM disposal with the 6-day, although there was an extra question on that one. Would you like to deal with that one, Adele?
Yeah, it's solely based on the date of completion.
Thank you, Adele. Right, other questions that are there. Changes to pension rules. Again, you covered that one off. So that's actually delaying when you can take your tax-free cash. Thankfully for me, I'm 55 next month, so I can still do it. But yes, it's going to affect some other people in the future. So corporation tax and the 250 limit. Mark, do you want to take that one? And actually, I think you could deal with the profit remuneration question as well.
Yeah, that's fine. I can take both of those. So in terms of the CT rates, it's not, there's no threshold band like there is for income tax. It's the rate applies to the whole profit if you're over 250 grand. So the small profits rate, 19%, only applies to companies with profits at or below the lower limit. So it's very important that you know, effective tax planning is done before the end of the year, so that you know what band you're going to be in. So from that point of view, you know, all of it, if the profit is over 250, all of it is subject to the higher 25% rate. That is in line with the rules that they previously had in 2015. So, you know, they've basically just reintroduced the rules that they had 5-6 years ago. In terms of the remuneration planning, it is, as Adele and Andrew have said previously, it is quite difficult to say an actual threshold, because there's so many rates and so many different things in play for each individual. It's almost on a case-by-case basis. And there's lots of things that will factor into that answer. So in terms of the actual threshold, it's worth just having a chat with us, and we'll just have a look at your effective remuneration strategy for the company, for you as an individual, and take everything into account to come up with the answer, because otherwise you just oversimplify it and you're likely to miss something.
Thank you, Mark. Yes, that whole remuneration bit is quite complex and very individual, I've always found. Some other questions I can knock off quite quickly. Did they announce yet how quasi-government bodies will be recompensated for the social and healthcare levy? No. Hopefully there might be some detail when the finance bill is published in November, but I'm afraid I can't answer that question. I think the Richard Laws question is a really good question. I didn't see any variations that might help the recruitment of low-skilled workers into UK manufacturing and supply chain. Now, that is clearly a big issue at the moment. It's not just manufacturing, it affects a lot of businesses. It's quite frustrating there. I know they're focusing on the high skilled, but actually the problem seems to be at the moment at the low area. I think how they have decided to try and do it is with things like the increase in the minimum wage and the increase, the reduction in tapering as well. So, but whether that solves the problem is debatable. It clearly is politically, they don't want to open up the borders. So they need to work out how to deal with this properly, because I agree with Richard there. This is a real issue, and it's going to stifle a bit of the growth if we can't be solved. Yes, other questions we've done the iOS. There are no changes on SDLT, as question on housing or Help to Buy. So that's, yeah, no changes on that one. And the last question we have there is, yeah, do we have an opinion on the cost of the cost increases in the budget, and whether what the effect will be on the rate of inflation? Now, that is a really difficult question. There's clearly a lot of inflationary pressure at the moment. A lot of it's worldwide as well. So the debate is, I think, economically, whether the supply chain issues which are there at the moment, when they're solved, will that resolve it? I think there is a lot of central banks, etc., that are, and governments, praying it does. But there's clearly quite a pent up inflation problem at the moment. If I knew the answer to that one, I think I would be able to make some share bets and become very wealthy, but it's clearly quite a significant issue. And the second part of the question on that was whether the business rate relief for leisure and hospitality and retail, does that affect individual properties, the limit, or is it on a group basis? Well, from the announcement yesterday, it was group basis. So if you own 10 properties, you'll be capped on 110,000 in total. You won't get 110 per property. Now, that's what the announcement said yesterday, and so that's what I expect in the legislation. Okay, I think that concludes our webinar. We will send out details of the presenters' contacts as requested there in a follow-up. And I hope you enjoyed it. And if you've got other questions, please talk to your Bishop Fleming contact or any of us when you get the details. Thank you very much for attending, and hope you have a good day.